If you have a franchise or non-franchise dealership in Kentucky, you have a lot of skin in the game with both the number and total value of cars on your lot each day. Your financial livelihood is at risk, and you want to make sure you're covered properly without overpaying for insurance. There are several different insurance coverages you need to protect you and your business financially and the reputation you've built. For the purpose of this video, we're going to talk in depth about your dealer open lot coverage, specifically using a non-reporting coverage versus a monthly reporting form. I am Adam Sheridan with Reed Brothers Insurance, and one area of insurance we focus specifically on is insuring garage and dealership operations. From one-man shops to large franchise dealerships, we build insurance programs for each level of your business. This coverage is called several different things: dealer blanket, inventory coverage, open lot coverage, floor plan insurance, and the list goes on. It's also covered several different ways. When working with franchise dealerships, whether it be GM, Hyundai, Toyota, Chrysler, you're sometimes offered this coverage as part of the floor plan financing package you put together with your brand. We see these packages all the time, especially for new franchise dealerships just starting out. Don't get it twisted though. You aren't just being given the insurance. You're still paying for it. The insurance coverages they set for you are no different than what you can find on the open market. You're just paying your franchise brand rather than having an agent shop the best coverage for you. Depending on the insurance company, you can structure your floor plan coverage one of two ways. One is a non-reporting form basis, and the other way is a monthly reporting form basis. Typically, our dealerships that have less than $750,000 up to $1 million in inventory usually go with a non-reporting form. The inventory you carry on your lot changes week to week, even day to day. But with a non-reporting form, you are telling the insurance company you only want physical damage coverage on your vehicles for a predetermined maximum limit. So if you have $500,000 worth of vehicles on your lot, you would tell your company you only want coverage for a maximum of $500,000. Where you could run into trouble here, obviously, is if you hit a run of good luck at an auction on some deals you can't pass up, and your inventory temporarily surpasses that $500,000 threshold, because that's when the next hailstorm would roll through town, right? The insurance company would only pay a maximum of that $500,000, even if you had $600,000 on your lot at the time of the claim. Typically, when we work with lots that have $1 million or more in inventory, we encourage them to use what's called a monthly reporting form. This is easier and less daunting than it sounds. You pull your financial statement at the end of the month, or whatever similar report it is you run. With just a few clicks, you send that total inventory on hand to the insurance company. You don't list all your cars or anything like that. It's simply the total amount on hand at the end of the month. Why would you want to add this extra step? Well, there are several advantages. Like the earlier example, we mentioned the total value of vehicles on your lot changes day to day. If you look back at past financial statements, some months are typically much higher or sometimes much lower than the month before. You don't want to have to remember to increase your inventory with the insurance company each month. So the reporting form option covers you based on a rolling 12-month average. This allows your inventory to fluctuate high or low while still keeping you covered. This option can give you both better coverage while also saving you money, which is exactly what you want, right? Let's say on a high end you have $10 million in inventory, but on a low end it may hit $8 million some months, especially right now when getting inventory in is insanely difficult. Your average inventory over the past 12 months is only $9 million. Choosing a non-reporting form means you'd have to be covered and pay the premium for a maximum of $10 million in coverage. Choosing a reporting form would allow you to still be covered for the same $10 million in coverage, but you'd only be paying premium based on the $9 million. See? Same or better coverage, but at a better price. It's a win-win. You may be thinking, look, I'm way too busy to add something else to my to-do list at the end of the month. The good news here is insurance companies that offer a reporting form basis typically give you until 15 days into the next month to get this report in on time. For example, you would have until June 15th to submit your May inventory report. If you have a dealership or garage business in Kentucky and have more questions about your insurance program, give us a call. You can email me at asheridan@rbisomerset.com. Visit our website anytime, rbisomerset.com, and on there you'll find more information and videos just like this one to help answer any questions you have. including an interactive graphic to pinpoint areas of your business that may be exposed to a potential claim. We look forward to working with you.